In this presentation, I'm interested to talk about provisions and events after the reporting period. Provisions and events after the reporting period. Some would prefer to say events after the balance sheet date. So the big question we're trying to answer today is the question about provisions. Why IAS 37 and why provisions? So basically, the standard IAS 37, it talks about provisions, contingent liabilities, and contingent assets. So the standard aims to ensure that appropriate recognition criteria and measurement basis are applied to provisions, contingent liabilities, and contingent assets. So are we going to explain what provisions are and try to differentiate the difference between provisions, contingent liabilities, and contingent assets? And the standard also aims to make sure that sufficient information is disclosed in the notes to the financial statements to enable the users to understand their nature, timing, and amount. Who are the users of financial statements? It could be the money lenders, the banks. It could be the owners of the business who are the shareholders. It could be the employees or stakeholders of the business, or whoever has got interest in the business, has got interest to understand about how the business is performing. And IAS 37 also aims to make sure that there is consistency and uniformity in the recognition of the provisions so that companies wanting to show their results in the most favorable light should not make large one-off provisions. Sometimes in the past, before the existence or the establishment of IAS 37, companies would want to make, or they were making large one-off provisions in years where there were high level of underlying profits. So basically that was done to understate profits, thereby understating tax eventually. So the establishment of IAS 37 is here to make sure that there is uniformity, okay? Uniformity across the globe on how provisions are done. So definitions, what is a provision? So first things first, a provision is a liability of uncertain timing or amount. It's a liability. So how do we treat liabilities? As an accountant, that is a given fact that liabilities that are meant to be paid within 12 months becomes current liabilities, and liability that spans more than 12 months, they are treated as non-current liabilities. Okay, so a liability, first of all, is a present obligation. What is an obligation? We're going to find out. The present obligation of an entity arising from the past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. Firstly, it's a present obligation. We're talking about today. Presently, we've got an obligation for the entity which arises from the past event. Past event would mean a transaction or an agreement that happened between parties to a contract, of which the result of this present obligation will result to an outflow of economic resources from the business. The company will end up paying, okay? Outflow of resources shall mean paying a reduction of the value of the company through paying. Okay. So the recognition criteria of I-37 states that a provision should be recognized as a liability in the financial statements when and only when, number one, an entity has got a present obligation. The obligation can be legal or constructive as a result of the past event, as I already alluded to. Number two, it is probable that the outflow of resources embodying economic benefits will be required to settle the obligation. There's a level of probability. The probability, it has to be probable. Probability shall mean more than 50%. More than 50% chance that an event will occur. There has to be that level of probability. Okay. Number three, there's a reliable estimate, or a reliable estimate can be made of the amount of the obligation. If these three conditions are not met, that is something else. That is something that is not discussed under IAS 37. Okay. So the meaning of the obligation is that standard IAS 37 defines constructive obligation as an obligation that derives from the entity's actions, where by an established pattern of the past practice, published policies, or sufficiently specific current statement, the entity has indicated to other parties that it will accept certain responsibilities. And condition number two, as a result, the entity has created a valid expectation on the part of those other parties that it will discharge those responsibilities. An example would be, suppose that a company has been given a contract to construct a dam. Okay. So within the process of embarking on the contract of constructing a dam, the company has decided to employ people for the construction to take place. Okay. These people haven't been paid yet. They have not been paid yet. However, there is an expectation that payment is going to be made. There is a constructive obligation where a company is supposed to honor the dues of the people that have been taken on board on a construction of the dam. Okay, these people or these employees may be grouped into two. First batch is people who are fixed on the terms of the contract. Second batch may be temporal. These people who are fixed, who've got a fixed contract on the project, whether the project is taking place or not, they are supposed to be paid. Constructively, there's an obligation that arises. Okay. And a second example would be where a company decide to have an establishment of an asset, let's say extraction of uranium at a certain place. Then the contract between the company and the government states that after the extraction of the uranium ceases, the place where the company is extracting uranium shall be, shall be taken back as if there was no any extraction of uranium, meaning to say the company's got an obligation to make sure that the place is cleaned up or disinfected of any exposure to radiation. Constructively, this company that has been given a contract to extract uranium can provide a cost, a future cost, which can be discounted to the present value for the cost that will be incurred to take back the place to where it used to be. okay, or the removal of any damages that may happen on the place. I hope it makes sense. Okay, an example: Parker Company sells goods with a warranty under which customers are covered for the cost of the repairs of any manufacturing defect that becomes apparent within first 6 months of purchase. Find the provisions required as per the company's past experience and the future expectations indicate the following pattern of likely repairs. Percentage of goods sold at a level of 75%, there are no defects. The cost of repairs in all items suffered from the defects is new. Yeah. Percentage of cost of goods, 20%, defects, minor, and the cost of repairs, if all items suffered from the defects, $1 million. Percentage of goods sold, 5%, defects, major, cost of repairs, if all items suffered from the defects, $4 million. The question is, how much should the company provide having had the probabilities? So what you're gonna do, given a question like this in exam, you simply say 75% of 0 plus 20% of 1 million plus 5% of 4 million. The result that you find should be your provision. So get your calculator and calculate what will be the answer. Is for your assignment. It's for you to calculate. Provisions for restructuring. Provisions for restructuring. The standard defines restructuring as a program that is planned and is controlled by the management and materially changes one of the two things. Number one, the scope of the business undertaken by the entity. Number two, the manner in which that business is conducted. We're talking about restructuring or reorganization in other terms. So IAS 37 gives the following examples of events that may fall under the definition of restructuring. One, the sale or termination of a line of business. Two, the closure of business locations in a country or region, or the relocation of business activities from one country region to the other or to another. Number three, changes in management structure. For example, the elimination of a layer of management. Restructuring. I would want to extend where they say changes in management structure. Okay. Suppose that a business is got one man's business or sole trader has got 10 companies that are doing different, that are supplying different supplies. Could be a service or a delivery of goods or services. So in these companies, there were separate organization structures where there's a CEO, there are several departments, accounting department, procurement department, marketing department, so on and so forth. So the company decides, okay, or the owner of the business decides to restructure or to reorganize how business is conducted, where they say, okay, instead of having CEOs in all these companies, why can't we have one CEO who can undertake the operation of all these companies? Depending on the level of operation, that way things can work, whereby the company would reduce costs by centralizing the operation of the business, where they would say, okay, let's have one department for all the companies, or one department to carry all the departments. Okay. one accounting department to cater for all the companies, and one procurement department to cater for all the companies. It's got its advantages, and of course, it's got its own disadvantages. That's about changes in management structure. Or you'd say, okay, let's remove one layer because there's duplication of duties. Why would you pay people where there's some sort of duplication of duties? Why not having one manager for different departments? Something like that. Okay. And another example would be fundamental reorganization that have a material effect on the nature and focus of the entity's operations. Okay, so disclosures. What does the standard say about disclosures? Disclosures for provision fall into two parts. That is the details of the change in carrying value of the provision from the beginning of the year to the year end. Okay, you would have a provision at the beginning of the year. And due to other circumstances beyond management control, there may be changes in the carrying amount of the provision that would need or that would trigger a change upwards or downwards of the balance of the provision at the year end. Okay, disclosure of the background or the background to the making of the provision and the uncertainties affecting its outcome. At the beginning of the year, management would have an assumption that things will happen this way. Then within the year, things happen otherwise. At the end of the year, scenarios to the effect of the provision may change. That would trigger management to disclose the effect of that provision to the financial statements. Okay, let's dive into contingent liabilities and contingent assets. So the standard defines contingent liability as a possible obligation, underlining the word possible. It might be a possible obligation that arises from the past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more of the uncertain future events, not wholly within the control of the entity. So the difference between a provision and a contingent liability is that a contingent liability is a possible obligation. It may happen or it may not happen. So the occurrence of this possible obligation will be confirmed only by the occurrence of or an occurrence of uncertain future events. That is not in the control of management of the business. Okay. So a present obligation that arises from the past events, but it is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation. It is not probable, or the chances of the occurrence of the event are minimal. So the amount of the obligation cannot be measured with sufficient reliability. Okay, so how do the contingent liabilities be treated? The contingent liabilities should not be recognized in the financial statements because the probability of the event happening is minimal. Number two, the event cannot be measured sufficiently. Okay, but they should be disclosed in notes in the financial statements. The required disclosures of the contingent liabilities is that a brief description of the nature of the contingent liabilities should be put up. Okay, an estimate of its financial effect to the financial statements and an indication of the uncertainties that exist. Okay, and the possibilities of any reimbursement that may occur. I hope it makes sense. Let's dive into contingent assets. What are contingent assets? IAS 37 defines contingent assets as a possible asset, underlying the word possible. A possible asset that arises from the past events and whose existence will be confirmed by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the management of the business. Okay? So a contingent asset must not be recognized at all. Only when the realization of the related economic benefits is visually certain should recognition take place. At that point of recognition, the asset is no longer a contingent asset. Another standard chips in. Okay? Let's look at the examples. A company is engaged in a legal dispute. The outcome of the legal dispute is not known. A number of possibilities arises. One, it expects to have to pay about $100,000. If it expects to pay $100,000, a provision is recognized. Why? Because the company, there's a reliable measure of the provision. Two, possible damages are $100,000, but it is not expected to have to pay them. A contingent liability is therefore disclosed. Okay? Why? There's some sort of possibilities. Okay? The company expects to have to pay damages, but it is unable to estimate the amount. The result, a contingent liability is disclosed. Why disclosing? Because there's some sort of expectation. Okay? There is some level of expectation. So another example, the company expects to receive damages of $100,000, and this is visually certain. An asset is recognized. Why? There is certainty. Okay, there is an aspect of certainty. Let's look at an example. The company expects to probably receive damages of $1,000. A contingent asset is disclosed. Why? There's a probability that damages will be received. Okay? The company thinks it may receive damages, but it is not probable. Therefore, there should not be any disclosure. Okay? Because it is not probable. There's no reliable measure. Okay? How should contingent liabilities be disclosed? A brief description must be provided for all material contingent liabilities unless they are likely to be remote, minimal, remote. In addition, need to provide an estimate of their financial impact to the financial statements and details of any uncertainties that may arise. Okay? And the possibility of any reimbursement if need be. Okay? Disclosure of contingent assets. The contingent assets must only be disclosed in notes or in the notes if they are probable, if there is some level of probability. In that case, a brief description of the contingent asset should be provided along with an estimate of its likely financial effect to the financial statement. So as a rule of thumb, probable means more than 50% likelihood that an event will occur. Okay, so here there's a flow chart of an exam. Given a question, you should ask yourself, should you disclose the contingent liabilities, or should you do nothing? An examiner is so clever enough to give you a question. If you are an F7 student, it may be a straightforward, but if you are an SBR student, strategic business reporting student, questions are asked, and there's an assumption that you think like a manager, you think like a consultant, and your thinking process is at that high level. So the way they would ask you questions is they would want you to reason. An examiner would want you to reason enough. So it's not, sometimes it's not straightforward. You've got to put in some brains into the question. Okay, so you should ask yourself, does a present obligation, is there any present obligation as a result of a past event? If no, then ask yourself, is there any possible obligation? If no, then do nothing. Okay. Is there any possible obligation as a result of an obligation event? If yes, then you should ask yourself again, is there any probability of cash outflow as a result of this consequence? Yes. Then ask yourself another question. Do you have a reliable measure or reliable estimate of the provision? Yes, then you got to provide. Otherwise, disclose a contingent liability. Okay. So let's look at events after the reporting period. Some would choose to say events after the balance sheet date. International Accounting Standard number 10. Very easy standard, very brief standard. And IAS 10 sets out the criteria for recognizing events occurring after the reporting date or after the balance sheet date. So events occurring after the reporting period are those events, both they might be favorable or unfavorable to the business, that occur between the end of the reporting period and at the date on which the financial statements are authorized for issue. These financial statements have not yet been authorized for issue, but the financial statements have been prepared and everything has been done, just waiting for management to approve or the shareholders to approve, the board of directors to approve for the issue of the financial statements. So two types of events can be identified. Number one, those events that provide evidence of conditions that existed at the end of the reporting period. That is to say, these events are adjusting events because there's an evidence of the conditions that existed at the end of the reporting period. Those, my friends, is an adjusting event. Number two, it may also be that there may be events, those that are indicative of conditions that arose after the reporting period. My friends, that one is an adjusting event unless otherwise stated. Okay, an examiner would also want to test you on this area. It's a small topic, but it's got some level of effect to the financial statements, even in real life, real business life. So the events that require adjustments. So an entity shall adjust the amounts recognized in its financial statements to reflect adjusting events after the reporting period. So an entity shall not adjust the amounts recognized in the financial statements to reflect non-adjusting events after the reporting period. So what would be the examples of adjusting events? These would be, for example, the sale of inventory after the reporting period for less than its carrying value at the year end. If you sell inventory less than its carrying value, what would be the effect? You have sold the inventory at less the sales value. The result is your closing cost, your closing inventory, the cost of sales has been affected. Your sales has been affected. So the end result is that your profit obviously has also been affected. Okay. Evidence of permanent diminution in property or in property value prior to the year end. If the property value has been reduced compared to the carrying value, that is also got an effect. You need to adjust. insolvency of a customer with a balance owing at the year end. If you got a customer and before the financial statements are signed off, and this customer you sold goods or services on a credit, okay, your receivables have been affected. So your balances on the in the balance sheet are heavily affected. So what will be the end result? You're gonna you're gonna expense, going to expense the liability of the customer that is going to servicing, and that's got a direct effect to your profit, thereby increasing your expenses and reducing your profit, eventually reducing your tax liability. So all these kind of effects affect the financial statements result. Amounts received or paid in respect of legal insurance claims, which were in negotiation at the year end. At the year end, suppose you provided that a case would work in your favor, and it happens that the case never worked in your favor. So you gotta go back and adjust, pass a journal and adjust. Okay. Determination after the year end of the sale or purchase price of an asset sold or the purchase before the year end. That one, my friends, is also the adjusting event. Evidence of a permanent diminution in value of the long-term investment prior to the year end. Adjusting event. Discovery of error or flawed, which shows that the financial statements were incorrect. Adjust. Okay. Events not requiring adjustment. Number one, so the standard gives the following examples for the events that should not require an adjustment of your financial statements. Acquisition of or disposal of a subsidiary after the year end. That, my friends, do nothing. It will affect the following year events. It will affect the following year transaction. It's a transaction that will be done in the following year. Okay, the financial statements should not be adjusted. Destruction of the production plant by fire after the reporting period. It's an unseen circumstance. Do nothing. Okay. Announcement or commencing implementation of a major restructuring. It's just an announcement. So don't be shaken. Don't do anything to the financial statements. A share transaction after the reporting period. Nothing. No adjustment. Litigation commenced after the reporting period. The litigation has just commenced. Do nothing. Okay. Announcement of a plan to discontinue an operation. Do nothing. Why? It's an announcement. Just an announcement. There's no any major effect to the operation of the business. So the most important thing is to note that if non-adjusting events after the reporting period are material, non-disclosure could influence the economic decisions of the users taken on the basis of the financial statements. Accordingly, an entity shall disclose the following for each material category of non-adjusting event after the reporting period, and that is the nature of the event should be disclosed. So information containing an estimate of the financial effect or the statement that such an estimate cannot be made. Okay. There we've reached an end. We've reached the end of my presentation. For reference sake, I took this information straight from SCCA F7 financial reporting. So it's a BPP 2019 edition. So should you require to go back and get more information, or you want to refer, get more examples, you are free to do so, and urge you to practice more. Get a past paper, practice more. The more you practice, the more content, the more information that you absorb. Okay, if you absorb more information, it's going to be easy for you to endeavor in to salvage the exams. The most important thing is understand the content, understand the concept, so that when the examiner asks you in any angle, you'll be able to answer and give correct answers. Otherwise, I wish you all the best. I remain PJ Palawi. Thank you. Bye-bye.